Hi, it's November 23rd, 2015, Monday. It's 1:25 p.m. London time, so it's 8:25 New York time. We've got about 3 hours until the Fed expedited meeting. But what I wanted to talk to you about today is MOPE, or Management of Perception Economics. And that's a term that's used by Jim Sinclair of jsmindset.com. It's a blog, economic blog. Jim Sinclair was called Mr. Gold back in the 1970s. So he's been around for a long time. So MOPE is basically a strategy used by the powers that be it central bankers, be it members of the IMF, economists for the IMF or World Bank, and even finance ministers or treasury secretaries or chancellors of the exchequer in the UK, and even bankers in the last few years. Especially economists for the big banks in the last few years, they've been kind of, trying to go along with the policymakers because, it's in their own interest, even though sometimes they do come out with interesting analysis of and criticism of central banks. As a whole, they kind of follow this MOPE strategy, which is basically using economic data and also comments to try to influence the public's perception of economic reality, and basically is a public relations scheme to try to make people act in a certain fashion. For example, if the economy is in a deep recession, the central bank will cut rates aggressively. The Treasury will implement through Congress a fiscal stimulus, and together they'll be on the same playbook. And after a few months, Chair Yellen or Jack Lew of the Treasury will come out, for example, and say, oh, our program of monetary stimulus and fiscal stimulus is working. We're seeing, economic recovery now. We expect, the economy to be growing strongly next spring. And with that, they expect the markets and the public to feel more confident and thereby maybe spend more and borrow more. And they're trying to influence the economy. They're trying to get the stock market higher so they have the wealth effect. And this is something that Alan Greenspan talks in his book The Age of Turbulence, about the wealth effect and how they policymakers try to impact public confidence, basically trying to get people spending. It's kind of their economic policy. It's almost like trying to push people mentally to do it. It's not like a laissez-faire policy of let the market cure the overexuberance, let the economy grow organically, let people, decide for themselves. They're trying to this MOPE. And a good example of MOPE in real life was back in 2009, after the Fed had started QE. Towards the end of 2009, we started hearing the term green shoots. It was used by the mainstream economists. You'd hear it all day on CNBC. Fed members would come out and make comments that we've got green shoots. We expect the economy to be in full recovery mode by the spring of 2010, and we won't need to do any more QE. But that didn't really quite work. It has worked to some, I guess, to some extent for the stock market, because we've seen, with the zero interest rate in QE, we've seen the stock market, go from around 6,600 the Dow in the low in '09, and now we're like at 18,000. So it's helped, in that sense, and it's improved the wealth effect, but it hasn't really affected the majority of the public, because majority of the public don't have a huge stock portfolio. It has impacted more on Wall Street, the hedge funds and mutual funds. They've done well from it. The MOPE has worked, and another thing that MOPE and also zero interest rate policy has helped is encourage corporations to do share buybacks, which is basically borrowing money at 0%. These corporations do, and they take that money and they buy back and retire shares in their own companies. What that does is that decreases the amount of outstanding shares of the company, and even if the earnings for that company don't improve significantly, the earnings per share ratio will improve, because the common denominator, which is the amount of shares, is decreased because it's been bought back with money borrowed at zero interest rates. So that kind of has been the main engine of the rally in the stock market for the last few years. It says, free money, and these corporations have been buying back their shares, and that's pushing their share price. That's helping the executives in those companies, because they have shares and, company shares. They're paid compensation with shares and share options, and they're laughing all the way to the bank. But the analogy of this strategy of buybacks is if you, as a homeowner, for example, were offered a mortgage at 0%, and you borrowed money at 0%, and you bought shares in your house to increase the price of your house, so you could borrow more money, to buy things for yourself. It just doesn't make economic sense to do that, to borrow money to buy your own assets, to make them look more valuable so you can borrow more money. It's a recipe for disaster, in my opinion. And the reason I'm talking about MOPE today is because I think central planners, i.e. central banks, are starting to get concerned about MOPE. They've been able to keep the public and investors quite optimistic since the crash of '08, and since the bottom of the stock market in '09. But I think more and more people, especially the general public, they don't buy into the recovery that we're supposedly having. We have 94 million people not in the labor force in the U.S., and they are of working age, but they're just not counted because they've given up looking for work, and they've been out of work for too long. They're not even counted anymore. So the 5.5% unemployment rate that we hear about, which is supposedly really good, is really it's not real. It doesn't reflect the health of the economy. So I think central bankers are worried. You look at Europe and the ECB. They're at zero rates, and they're threatening, even more. They have some of their rates. They have one of the rates that's negative, and they're threatening to make them even more negative. They keep threatening to. They're doing, loads of QE still. And even in England or in the UK, we're told that the recovery is really strong, but we still have the budget deficits, and a lot of people, they are officially not unemployed, but they're on something called zero-hour contracts, which basically mean that you don't have a contract with a company. a normal, traditional employment contract, what you do have is that they can call you with no notice, and to come and work for a day, and they'll pay you just for a day, and then they say we don't need you anymore, and then they'll call you again in 3 months' time. So a lot of people are on these 0-hour contracts, and they're not counted as unemployed, even though they're not earning much. So I think what's gonna maybe trigger a change of heart for the Fed, where they will come out and probably say, yeah, we're wrong. The economy is not doing well. We're going to have to reverse the rate hike we did on December 16th, even though even I speculated the other day that they might do it today at their emergency meeting. Even if they hike today or on December 16th, I'm sure they'll have to come out very soon after that and say that they'll have to reverse it, or they'll have to start doing QE again, because they'll use the current mood of fear that the mainstream media and politicians are trying to instill the mood of fear, just because of, well, I don't say just because, I don't want to be flippant, because of the of this terrorist attack in Paris on the 13th. It's a horrible thing that happened, but they might use that, especially the Fed, as an excuse to reverse their policy of raising rates for the first time in eons, and then raising rates gradually. They might come out today. That's what they might be saying today. They're going to say, with what happened in Paris, we're actually on hold. We're not going to raise rates anymore in December. Or they might raise rates, like I said the other day. I don't know. It's all, I'm not a fly in the wall of at the Mariner Eccles building in Washington, D.C., so I don't really know. We'll have to wait and see. What else in terms of MOPE? No, that's about it. So management of perception economics, that's quite interesting, and I think they're at the end of the rope in terms of MOPE. It's not going to work anymore, because you can't fool, I guess you can fool most of the people most of the time, but you can't fool everybody all of the time, and that's worked in their favor for the last few years, but it's getting precarious now. So we'll have to wait and see what happens. We'll have to see if they can able to continue to manipulate currency prices, and by that I mean gold and silver, because they are currencies. You might say, oh, they're not important. They're, why are they important? But the biggest central banks in the world and treasuries in the world hold loads of gold. The U.S. Treasury has over 8,000 tons. The German Bundesbank has over 3,000 tons. The Chinese have been accumulating a lot of physical gold alongside the Russians for the last few years. So I think MOPE has been used with gold and silver. They've been manipulating the price down. Why? Because gold is a thermometer for the health of the dollar, and the dollar is the reserve currency. The dollar is the base of the monetary system, and if you have gold rising while they're doing QE, confidence in that policy of QE would not have been there. So that's why since they started doing QE, or when they got into the real meat of QE, gold has been going down since 2011, from 1900 to 1067 right now. We're down $10 already, before the open of the stock market, which is in about an hour. Silver's been driven back below $14. So it seems to happen every morning in London. Gold will do well overnight, and then it drops in London, and then it keeps dropping when the U.S. opens. And even if it's very strong in London in the morning, when New York opens, gold starts going down, and it hardly ever closes on the highs of the day. And by closing, I mean the close in New York or on the COMEX. But I think, yeah, the central banks have been manipulating the price of gold with the bullion banks because they need to keep the gold thermometer needs to be kept down. It's like, if you have a fever and you use the thermometer, it will go up to the high temperature. But if you put it in a bucket of ice, that temperature will come down, but you still have the fever. So that's what they've been doing with the price of gold. They've been putting the gold thermometer in the bucket of ice, even though a lot of people, like me and all the gold bugs, they're gold bugs. Jim Sinclair, Eric Sprott, Jim Rickards, a lot of these people, they've been saying gold should be a lot higher. They're printing money all over the world, and interest rates are at zero in nominal terms, and in real terms, even though their official inflation rates are low, real interest rates are negative. And so how can gold not be doing well? It just doesn't make sense. It's very frustrating for people who have put some of their savings into gold, but I think if you don't use gold as a speculation, if you use it as an insurance policy, and you keep it long-term in physical form, you'll be fine. It's very frustrating, but I think the MOPE of the gold market, the manipulation of the gold market, or the perception that gold is not doing well, and that's done through driving the price lower. And how do they do that? Well, they borrow gold into existence. They hypothecate their gold holdings. And it's mostly done in London because there's no limit to hypothecation in London. There's limit in New York to how much you can rehypothecate, but not in London. So, the Bank of England probably, uses gold that they hold for other central banks, or the UK's own gold. They rehypothecate that and they lend it to their bullion banks. And their bullion banks take it and they sell it short. And they borrow that and sell it short. And they drive the price lower, buy it back. They keep playing that game. And whenever gold starts moving higher and threatens technical levels, they'll just go back and borrow more physical gold from the central banks. It's all on paper, and they keep the price down. One day that will end. Their management of perception of the gold price, just like it did in 1968 in the London gold pool. And back then it was overt, and they couldn't even keep that going. Right now it's covert, but they won't be able to keep it going forever because they'll run out of physical gold. Because the Chinese and the Russians, they don't want paper gold. They want physical like that. And that's what you should have: physical gold and physical silver. Very simple. I'll talk to you later. Take care.